Hello, and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. We're both tax partners in RSM's London office, and this podcast is aimed at private client professionals, fellow tax practitioners, bankers, lawyers, trustees, etc. Anyone, in fact, who has a focus on private clients and private wealth. Before we get into this week's subject, our first episode focused on wealth taxes, and this continues to be discussed in the press. We have recently heard that a group of eminent academics and ex-civil servants have formed a commission which is to investigate how a wealth tax could be introduced to the UK. We will keep you posted on developments on this subject. Last week we talked about trusts and tax, but deliberately ignored inheritance tax. So today it's time to grit our teeth and deal with the subject of trusts and death.
So, to give us a bit of context as to trust and inheritance tax and why the two things are really sort of so bound up together, let's talk about Pride and Prejudice.
Oh, let's talk about Colin Firth.
Or maybe not. The point about Pride and Prejudice when it comes to trusts and inheritance is that this is the whole sort of prime mover of the plot. So the Bennet family has 5 daughters and no sons. And the problem they've got is that they've got to marry off all of these daughters because none of them are going to inherit Mr. Bennet's estate. And the reason for that is because the estate is what's called entailed. Mm-hmm. And basically that means that the estate is held in trust and will be inherited by the closest male heir, which in Pride and Prejudice is the absolutely appalling and creepy Mr. Collins.
Yes, he was very appalling and very creepy.
Trusts go back a long way and have always been really tightly tied up with inheritance. In Pride and Prejudice, the point was to keep the estate in the family bloodline, mm-hmm. to pass it down so that the Bennet family name or the Bennet family bloodline would always be associated with that, and the estate itself wouldn't be broken up between different family members. And actually, that sentiment remains really valid today, although I would hope in a much less sexist way. If you've built up a successful company over your lifetime, you may well not want the shares in that company to end up being spread out between all of your children, and let alone being broken up further when it comes to grandchildren. It doesn't take very long after your death for a company that had a sole driving force behind it to have 8 or 10 different shareholders, some of whom have got nothing to do with it at all, and who are just wanting to cash in, sell the thing off, and make a quick buck. And if you've got that concern, a trust is a really good solution because it means that the shares are held collectively. They're being controlled by trustees who've got to look at the interests of the family, not interests of individual family members. And they can employ specialists, managers who are actually going to be good at running the company rather than your children who've got no interest in it at all. So trusts are a really useful way of holding that family wealth together, and that continues to be as much the case today as it was under Jane Austen's times. So that's why you would still look at using a trust when it comes to estate planning and inheritance. But obviously what we want to focus on mainly here is the tax implications. And this is where it gets very complicated, not least because the situation is going to be different depending on whether assets are transferred during your lifetime or on death, mm-hmm. and also the domicile of the settlor makes a big difference to the way the trust is going to be taxed. So, Rachel, do you want to talk a bit about domicile in this context?
Yes, I'm going to talk a little bit about it, but I do think, we could do a whole podcast on domicile. So we'll keep it brief for today's purposes. But very broadly speaking, we've got two very significant concepts for determining liability to tax in the UK. The one that we most normally refer to is residence, and people have an innate understanding of residence because it's where you live. The difficulty with IHT is effectively, or quite effectively, residence doesn't play a part in it. We are looking at a person's domicile as the determining criteria as to who's going to be assets in respect of inheritance tax. So for the purposes of today's podcast, we will just consider that somebody who is domiciled is going to be any person who has been resident in the UK for more than 15 years. So that's just one part of it. But now let's focus on somebody who is not domiciled in the UK and why they might use a trust. So bearing in mind what I've just said, as a domicile person, you're liable to inheritance tax, or you're in the charge to inheritance tax on your worldwide assets. But a non-dom is different. A non-dom is only subject to inheritance tax on their UK situs assets. So with that in mind, let's say a non-dom puts non-UK assets into a trust, then that trust will be known as an excluded property trust. And the idea of the excluded property trust is that the non-UK assets it holds are outside the scope of IHT. And that's, of course, consistent with the fact that the non-dom, as an individual whose non-UK assets would be outside the scope of IHT. So there's nothing funny going on there. But it is beneficial to the non-domicile person because the trust will continue to enjoy that inheritance tax exemption even once the settlor becomes UK domiciled. So again, going back to my simplistic view of domicile, if my non-dom person has recently arrived in the UK or has been here a few years, he is still non-dom, can put his foreign assets into an excluded property trust. And then once he has been resident here for that 15 years and is treated as a UK domicile, the inheritance tax advantages related to that trust will still continue.
And Rachel, just to sort of ask the question there, is really why do we have rules that work in that way? Why is it we want to say that a non-dom who holds assets personally, once they've been here for more than 15 years, those assets are subject to IHT, but if they hold them through a trust, they're not? You're laughing at me.
I have no idea.
So, is it as simple as this is just a way of encouraging non-doms to stay in the UK?
So it's only as the tax system has evolved that we've got this mismatch between income tax and capital gains for non-doms and inheritance tax. But again, Andrew, I do think that's a whole other podcast. So let's continue just to focus on the non-dom and trusts. Going back to what I was saying about the excluded property trust, there is one important exemption. A lot of non-doms may have trusts that, again, historically had underlying companies, and it was those companies that acquired UK residential property. And again, this used to be standard vanilla planning, and it kept that UK residential property outside the scope of inheritance tax. However, since 2017, when new legislation came in, that is no longer the case, and UK residential property, however it is held by an excluded property trust, will be within the scope of inheritance tax. I think it is worth mentioning, of course, a couple of other things related to excluded property trusts. Firstly, they don't have to be resident outside the UK. So I can have an onshore resident trust, so a UK resident trust, which is an excluded property trust. And it goes back to looking at what the criteria is. And the criteria is that it must be the settlor who is not domiciled at the time of settlement. And the exclusion relates to the non-UK assets. So if I have an onshore excluded property trust, the assets will be exempt as long as they are foreign. So, for example, if the cash that the trust holds is in a bank account in Jersey or in Germany or in the US or anywhere else, it will be exempt from IHT. Clearly, local rules will have to be considered as well on death.
I think that's a really important point, and I think it's one that people tend to forget or just be totally ignorant of. That, yeah, as you say, your excluded property trust can be run out of the UK.
Yep.
A lot of these trusts hold quite significant assets, and you quite often want professional trustees running the thing. And very often that will mean offshore trustees just because that's where the expertise is.
True.
But I guess in your bank account example, if you just had a trust which just had your Jersey bank account in it, you might have family trustees in the UK if you wanted them.
Absolutely. No reason not to.
Okay. In a way, the non-dom position is the easy bit. So let's look at the situation of a trust with a UK domiciled settlor, because here the analysis really does get a lot more complicated. The starting point, I think, where you've got a UK domiciled person settling a trust is that there will be an inheritance tax entry charge. So if I, as a UK domiciled individual, decide that I want to put £1 million into trust for Rachel's benefit, there will be inheritance tax payable at 20% on the value of the money going into that trust. Now, the nil rate band of £325,000 can be used to reduce that, but in my example of £1 million going in, there's still going to be a 20% tax charge on £675,000 as a cost of putting that money into trust on day one. So there's an upfront cost for UK DOMs creating a trust. There's also an ongoing periodic inheritance tax charge, which is, broadly speaking, up to 6% of the value of the trust assets, payable every 10 years. And actually that periodic charge also applies to Rachel's excluded property trust to the extent that it holds UK assets in it. So the base level is if a UK DOM creates a trust, there's likely to be tax payable on the way in, and there's then going to be an ongoing tax liability every 10 years, or equally when assets get taken out of that trust, you sort of have a prorated inheritance tax charge as well. Now, on top of that, if the settlor is able to benefit from the trust that he or she has created, then in addition to those periodic charges and that entry charge, you also have a death charge. So in my example, if I've created my trust for Rachel, if I'm also a beneficiary of that, I 20% charge on the whole value of the trust assets on my estate. So it actually, Rachel, it seems pretty punitive.
Yeah, I mean, it's just the way that the system works. I think it's worth saying that the logic of the periodic charges is that over a lifetime, the cumulative 6% that are paid every 10 years roughly will equate to the 40% inheritance tax that would be due on assets personally owned at death. It's only when the settlor retains an interest that the IHT over the lifetime is going to mean that, of course, overall the IHT payable on those assets or by that sort of family member is going to be higher than the 40% that we're used to seeing. So in summary, the very broad position is that if you are a UK domicile, you should either put assets into trust such that you cannot benefit from them, or else you get this sort of double charge, or you wait and settle the assets on your death. On the other hand, if you're a non-domicile person, you can have your cake and eat it. You can do both.
Just before we finish on the subject, there is one other thing I probably should have raised earlier, but will definitely raise now, which is there are a whole different set of rules where you're dealing with business or agricultural assets. So if you have assets such as shares in a private trading company, or you own a farm, or you've got a trading partnership, or anything where you've got a business or agricultural assets, those assets are exempt from inheritance tax because of specific legislation. So it's worth always bearing it in mind.
I think it's worth saying, just to finish on, trusts do have a bad reputation of being tax avoidance vehicles, but clearly from what we've just discussed and where IHT is concerned, it's a rather unfair reputation. And in most cases, it's just a different way of collecting tax, in that the government gets its tax either regularly over the years or on death, or sort of rather than on death in one lump sum. We've talked about death quite a bit. I'm not sure if we've got time for a recommendation, but just in case we have, do you want to give me a light-hearted one, Andrew?
Yeah, so I know that you like your podcast when you go for a walk, so I have another one to recommend for you.
Oh, excellent.
This is Simon Mayo, Mark Kermode film podcast. There's a fantastic relationship between Simon Mayo and Mark Kermode. It's really good fun. They're both brilliant broadcasters, and there's a real pleasure to the thing. It's light, it's fluffy, but it's perfect for you, especially as you're out battering the elements, to cheer you up on your daily walk.
Brilliant. It sounds just like a description of Tax in 10. Anyway, thank you all for listening. As always, please do let us have your comments and feedback. We can be contacted on our usual addresses, rachel.desouza@rsmuk.com or andrew.robbins@rsmuk.com. See you next time.
Thanks all.